And this is BizPulse only on ANN7 Prime. My name is Cindy Mabi. Good evening to you. The South African Reserve Bank has kept the repo rate unchanged at 6.75%. Governor Lesetja Kganyago says besides Moody's and Standard & Poor's, the ratings expected tomorrow, other risks to the currency include the elevated oil price, the ANC elective conference, among others. The Reserve Bank Governor Kganyago says that the weak fiscal forecast in the national budget announced in October reduced the scope for a rate cut. Kganyago says the domestic economic growth, although subdued, the outlook remains positive. The prime lending rate has also been left unchanged.
Average increases of 4.5% and 5.9% are now expected in 2018 and 2017, compared with previous forecasts of 5.3% and 5.9%. Furthermore, the endogenously determined path of the repo rate in the QPM also provides an offsetting effect. This path implies 3 interest rate increases of 25 basis points each by the end of 2019, compared with 1 increase previously. As we elaborate later, this does not imply an unconditional commitment to this policy path. The forecast for core inflation, which is unchanged at 4.8% for 2017, has been adjusted up by 0.2 percentage points in both 2018 and 2019 to 5.1% and 5.3% respectively. The inflation forecast generated by the bank's quarterly projection model, QPM, shows a deterioration since September. The average forecast for 2017 is unchanged at 5.3%, but has been revised upwards for 2018 and 2019 to 5.2% and 5.5% from 5.1% and 5.4% previously. The domestic growth outlook remains weak, continuing its deviation from the generally more favorable global pattern. Stronger world growth has contributed to a further increase in international oil prices, which could in turn provide a boost to global inflation. This may increase the pace of monetary policy tightening in the advanced economies, with possible implications for capital flows to emerging markets. The year-on-year inflation rate, as measured by the Consumer Price Index, CPI, for all urban areas measured 4.8% in October, down from 5.1% previously, marginally below the bank's short-term forecast.
And joining us in studio is Sepo Hadima, political analyst, and Tony Modise, market analyst. Kanti Pai is an economist. He joins us on the phone. We'll start with you, Mr. Pai. We believe your time is constrained. Good evening to you. The MPC not really having much of a choice considering the prevailing uncertainty, as the Reserve Bank governor indicated with regards to the economy.
Hi, Phil, good evening to your listeners. Yes, of course. I think that, they only have one instrument to fight inflation, and it's the interest rate, right? And you have to save your bullets or your guns for a moment where you actually need them. And as I stated, there's a lot of things that we know are on the forefront. The outcome of the ANC elections. There's certainly a number of things that we're going to see, including actually external factors that we have to think about. So all of these things, and then the downgrade, and all of these things that are possible, have to give them, they need some ammunition. And so you hold your guns now, even though perhaps there is an opportunity, as they say, that, our interest rates are really, our inflation is really low in terms of what we've been seeing over time. And, there's an opportunity to try and help growth. But certainly they have to hold their guns and try and save the ammunition for when they really need it, because there's a lot of risks that are on the horizon.
All right, but just talk us through the risk, and you are talking about external factors, and that I'm sure you mean imported inflation and the volatility of the currency. But talk us through those risks or imminent risks when it comes to the repo rate remaining the same.
Yeah, so I think one of the things we don't talk about is that we know our biggest investors come from the UK, for example. A lot of our biggest investors they have been for a long time, and our trade partner. Brexit itself is still quite uncertain. How does that actually pan out as they try to negotiate that? Those negotiations are quite difficult. Will that actually, affect growth negatively or positively? Will we need a rate cuts in the future to try and actually pop us our growth up. We know what is going on in China. There's a lot of volatility in China, which is, people are talking about the debt levels in China and the liquidity and what is actually going on in that economy. That could also cause some fallout. And, of course, the U.S. monetary policy has also been something that we've had to watch very closely. And now we understand that, the current, governor of the U.S. Reserve Bank is also, their tenure is actually ending, and we don't know who's coming in and what kind of policy they have. Trump's change of interest rate, of taxes and all of those things. So there's a lot of things that are going on that we have to manage as they come. And then, of course, we know what we're facing at home. What happens to a fallout that will come out in terms of a ratings downgrade, and how will we manage that, the volatility in the rand and the deterioration there. And we know there are issues of oil prices and OPEC. So there's a lot of things that are happening, moving parts. And if they don't have to use the change now, then they might as well hold it for later if actually some of these things materialize in a dramatic way, because they've got to have something, and there's only thing that they've got. So I think part of what they needed to do was to outline these risks, both domestically and externally, and then say, we'll hold our guns for now and watch. And also, I suppose also it was a positive for them when they said, look, we see growth marginally up from their last forecast, even though, obviously, it's not roaring growth, but in some sense, they think they're a little bit more upbeat than they were the last time they talked to us.
But very little reprieve for consumers, those that are debt-ridden, in the sense that we anticipating, because of the oil price and weak currency, the increase in petrol prices.
Yeah, so what they argued is that, real incomes are growing, so which is whatever your income increase was minus inflation. And they're saying, for some time now, most of us have been arguing for higher or above inflation increases. So we know many people would have been arguing for 6% and I think above, and settling at those levels, 7% maybe, and those who are lucky, probably even 8%. And they're saying, but inflation has shown to deteriorate over time. So our inflation has been around 5%, and now we sit below. So maybe there's a little bit of a reprieve in terms of our buying power, and that will allow us a little bit of space to be able to have a little bit more to spend, even though we're seeing some of these cost pressures that are there. But simply, this low inflation from where we come from seems to suggest that we have a little bit more than we did, I suppose, this time last year when inflation was much higher. So that suggests that perhaps, our real spending is a little bit better. I don't think it's realistic for most people, because most people will tell you, really, when you get to the shops, things are really, really much higher. But they think that, our real incomes are slightly better than what they would have been this time last year.
All right, Xanti, we're going to have to leave it there. Thanks indeed for your time. That's Xanti Pai, an economist joining us on the phone line. In studio, Tsepo Khadima, political analyst. Good evening to you again, Mr. Khadima. When you hear these kind of figures, there's no change. You know that your budget, similarly, will not have a drastic knock to it. But is there much to celebrate, though, under the current economic circumstances?
I think the key question that probably the people at home are more concerned with is that, what does all this mean to them in terms of their daily lives? And maybe first we need to be asking a question. Maybe they might have had a lot of ways, terms bandied around, like macroeconomic policy of a country, and we have spoken at length as to why the macroeconomic policy needs to be reformed. But there are two pillars within macroeconomic policy. So today we're dealing with the one pillar in terms of which is managed by the South African Reserve Bank. That is the monetary policy of a country. The other pillar, also very important, is the fiscal policy of a country, falling under macroeconomic policy. Fiscal policy effectively is taxes and spending by government. And the picture, I think, was drawn very vividly for us during the medium-term budget policy statement in terms of, on the fiscal policy front, how we are doing. And we are doing not good at all in that front. So today we're looking at the monetary policy. And what does monetary policy deal with, really? Monetary policy deals with money supply. It deals with also achieving, macroeconomic policy objectives of a nation, for example, interest rates, inflation, and those are the tools that are used to achieve what? Price stability. Because at the end of the day, that's really what you are concerned with, to say, well, where is the inflation? is the target of the South African Reserve Bank for inflation to be 6 to 3%, because they are wanting to see a declining inflation climate, and then interest rates that can be achievable, so that there can be more borrowing, hopefully to stimulate the economy to achieve growth, which also falls within the monetary policy of a country. So if we look at all those, what did Governor Lesetja Kganyago tell us today? 5.3% is the inflation. But when you now extrapolate as to what are the key components that go in there, food inflation, for example, which affects the majority of people, since we have higher levels of unemployment, food inflation unfortunately continues to be higher, and some estimates have been that it is as high as above 10%. So the other areas of the economy that deal with the industrial policy of a nation, whereby we have seen subdued output in the industrial policy front in terms of manufacturing, that meant that you can have an even lower inflation rate. Therefore, it gives you a distorted picture. And I'm saying, whenever they're putting out what the inflation rate is, we have to be looking at the jobs number. So that is the one element. And then, of course, the same thing with the GDP growth, which is should be the key concern under the monetary policy. What is the economy? At what level is it growing at? Because that's where you look at all these other variables. If you look at that front as well, in terms of economic growth, it's one thing to say is 0.7%. Again, you have to look in terms of what are the jobs numbers, because the jobs numbers support your fiscal policy as well as your monetary policy in terms of ability to stimulate growth. And on the fiscal policy front, I think the other things that Lesetja Kganyago didn't really delve much into is that what is the impact of a possible downgrade, and I believe that there will be a downgrade. Everything that I'm seeing tells me there will be a downgrade. Actually, what are the mitigating factors? Because we know this year, the earlier downgrades this year added on our interest cost 70 billion rand. So instead of us having to pay 169 billion rand in interest rates, in interest costs on our debt, we are now going to pay 239 billion. So 70 billion was added. So in the event of a downgrade tomorrow, that will bring in additional pain in terms of higher cost to our interest burden. Now that will immediately affect the fiscal policy, and more so on how government then can be able to continue to spend money in terms of particularly the social needs that clearly deal with the demand side of the economy.
No, and as the portfolio of finance minister of Malusi Gigaba, very difficult. He's gone to try and woo investors, the International Monetary Fund, and trying to at least stabilize the economy. But if you're talking about this bottomless pit of perpetual debt that is caused by external factors, really, what does that then mean for the economic growth forecast?
Well, first and foremost, we have to dispel the myth that whoever that has been spoken to is an investor. They are not an investor, because the bonds that they are being bought of the South African government, they are going solely only to service our interests. So it's not money that is coming into the economy. If we had 240 billion rand coming into this economy from the borrowings that government is doing, which Minister Malusi Gigaba is telling us that those are investors who will be giving us this 240 billion rand. If it was coming into the economy but not going to the already people who are holding our government bonds that need interest, which is the yield on that money, then we of course say, yes, these are investors, because then that money could be deployed into the economy. So the drawback is that all of the money that Minister Malusi Gigaba is raising and talking to the so-called international investors and even domestic investors is not money that is actually having a multiplier effect or aiding to the economy, and hence our economic growth remains subdued. If we had 240 billion rand come into this economy with our GDP size being where it is, it would mean that we would be able to achieve economic growth rate above 3%, and that will then give us a fighting chance to be able to reduce the higher levels of unemployment and be able to get the economy on a much more firmer trajectory. And that stimulation will give us stability, because then we'll have price stability. And the other thing, of course, that the Reserve Bank, I think they need to really find a way. Section 224 of the Constitution is no longer appropriate or adequate as they want to rely on it, because the currency continues to be to be volatile and weakening. And the Reserve Bank needs to be able to tell the nation as to why they believe that specifically trade settlements in terms of the imported goods, oil being one of the key imports into this country, or energy imports, which makes up a higher percentage. The question is, why are we settling that continually in US dollars, where there's a greater degree of volatility, when there are other basket of currencies which we should be settling our trade settlements or doing our trade settlements in, to ensure that we reduce, so that the volatility of the US dollar exchange rate to the rand will be of no effect in the real economy, because that happens in the derivative markets in terms of currency trading. Unfortunately, it affects the real economy when you now come into settling or doing your trade settlements. And that also is what is key contributing factor to the low real investment climate we are seeing in bricks and mortar, because investors are not able to take a long-term view on investing in South Africa in bricks and mortar industries, except, as I made the example yesterday, the auto sector have been investing in South Africa on the long term purely because of the Africa Growth Opportunity Act of exports into the United States. So they do not have the currency risk in terms of the volatility of fluctuation, because they import knockdown parts which they export in dollars.
Yeah, Mr. Modise, Tony Modise has been very patient on the line. Good evening to you, Tony, and thanks so much for joining us. It's Black Friday tomorrow, and with the interest rates or the repo rate remaining the same, it means your debt is essentially also stagnant. But your view just on the announcement, was it expected?
The announcement really, Cindy, it was expected. I mean, looking at the inflation that came out on Wednesday, or rather, it came out on Wednesday, which came out, it was down, and then it showed a little bit of confidence in consumers there. And then, I mean, with interest rates as well, they couldn't be cut or couldn't be hiked because of what might happen tomorrow. The rating agency will be rating South African economy. If ever they decide to rate us further to junk, that means that we'll start seeing a very huge outflow of capital out of South African economy, which will add pressure on the currency. Once the currency becomes a lot more weaker, with petrol prices hiking, and also with Eskom planning to hike that tariffs, this will eventually add a lot more pressure in South African inflation. And the Reserve Bank was literally paying attention to this sentiment that petrol prices are going up, oil going up. OPEC is still focusing on cutting down in supply to hike their prices further. All of the sentiments are really going to add pressure in South African economy. And looking at our economy literally right now is under pressure. It has slow growth. But tomorrow with Black Friday, they might basically push retail sales, and retail sales will add also to South African GDP, which might come out positive as well.
Is this a stimulation to the economy, or is it just a circulation of the currency, in the sense that what difference does it really make for one day where prices are reduced so that consumers are able to purchase what they otherwise wouldn't be able to do?
What we need is consumer spending, which shows that there's enough funds in circulation. As also enough funds in circulation adds to growth. It might not add to growth in a sense of us having foreign direct investment, but they show an element of transaction within South African consumers, and also an element of health in our economy, whereby wherever you want to invest, you look at the health in terms of the sales. Are people buying? Are people spending money? As long as people are spending money, there's potential of growth. That's what investors as well are looking at. Hence, we're paying more attention as well to the sales. As long as the sales are up, that means that people are spending money. When people are spending money, that is an element of basically attracting investors to invest in South African economy.
All right, Tony Modise, a market analyst, thanks so much for joining us. Very briefly, Rekha, just taking from what former finance minister said, that if Cyril Ramaphosa is ANC president, therefore we can avert to avoid any further downgrade. Your view?
I don't agree with that at all. for one simple reason. We're going to be downgraded for as long as we continue to pursue the fiscal policy that is based on deficit financing, meaning that we have got a big deficit, a widening deficit, and we are hoping to bridge that deficit through further borrowings, as has been said in the medium-term budget policy statement. The 6.75% interest rate is not going to be a stimulant until businesses are starting now to see increased borrowings by businesses to go into the productive sectors of the economy. But we cannot rely only on the consumer, because that component is a smaller component. It's not like in the United States, where the consumer is that much larger component that really carries the economy. So that is the challenges that we have. We need to see that low interest rate environment being a stimulus, increasing money that can go into businesses for productive sectors. Until that happens, everything else really it's academic.
Yeah, academic, same old, so to speak. Yes. Thanks so much, Tsepo Khadima, political analyst. We had Tony Modise, market analyst on the line, and Kanti Pai, an economist, also joining us on the phone line.